Hello, everybody. I'm Toby Shifsky. I'm the Executive Director of Kaplan Real Estate Education. And today, for our real expert presentation, we've got, well, it's a big topic. It's financing, what every licensee should know. I've got none other than Jerry Anderson. Jerry, thank you for being here today.
Thanks, Toby. I'm happy to be here.
Yeah, right on. Well, let me introduce you for those who don't know who Jerry is. So Jerry's been a long-time instructor at Kaplan. Was it 1999, Jerry? I think when you started?
Yes, I think it's 23 years now.
Yeah, I think we were called something else then. It was like ProSource Real Estate.
Correct. It was ProSource.
Yeah. For some of you who remember what that is, because when I started at Kaplan, it was a part of ProSource. And like every good company, we were purchased by a bigger company, Kaplan, and I've been there ever since. And you've been along the ride the whole time, Jerry.
Yes.
Let me give some reference for everybody. So Jerry, before he was started at Kaplan, he was a loan officer and started 1993 or 1983. Is that right, Jerry?
Correct. Yeah, 83, 40 years ago.
Holy moly! I was still in high school, Jerry. My goodness. All right. So
born yet,
yeah, half these people probably not. But here's the deal. He's been in the mortgage business since 1983. He's started his own mortgage lending firm in 1991 and oversaw the operation until 2008. During that time, Jerry also obtained his real estate license. So he's a unique cat. He's got a real estate license and he's got his mortgage license, right? So he started a real estate brokerage and also did a title company. That's called the trifecta. If you don't know, if you're in real estate, you know. If you got mortgage, title, and real estate, that's kind of the home run ball that everybody kind of goes for. And Jerry successfully grew his business to 60 staff and had multiple offices here in Minnesota. And if you guys all remember in 2008, well, some of you remember the huge mortgage financial meltdown and the financial crisis took a lot of people out of business. And Jerry learned a lesson. Jerry, you learned a hard lesson, which is you had to shut all three of your businesses down.
Correct.
Yeah. But like every good scrappy real estate and mortgage lender, you get back on the horse. And so Jerry is back on the horse. And he's been active not only as an instructor, but originating mortgages, consulting brokerages, right? So Jerry has been in the business, it still is. In fact, Jerry, since 2017, you went into specializing into a certain segment of the mortgage industry, and that is the reverse mortgage industry, correct?
That's correct, Toby. Yes, I found that there's a huge need for it. And yeah, I've enjoyed doing just those for the last, five and a half years.
5.5 years and teaching with us at Kaplan. And so, Jerry, everybody, here's who I go to when I have mortgage questions. So Jerry's here today and he's going to help us out, because what we're going to talk about, what we're going to really realize is we're going to understand exactly what is the lifeblood of the of the real estate industry. And frankly, odds are, the averages are nearly 80% of all residential real estate involves a mortgage. It involves some form of financing. So for things to move, financing has to happen. And Jerry is here to help us with the financing questions that we have. And so, Jerry, thank you for being here.
Well, I'm looking forward to it, Toby.
All right. Well, let's go ahead and jump in. Everybody, you're going to be able to play along and you're going to be able to understand kind of what's happening in the mortgage industry with us along with Jerry. So a couple big things, Jerry. I want to just ask one quick poll question of everybody if I can. So everybody on, I want to know who you are. This is all anonymous, but what I want to know is how long you've been in the mortgage industry. We do this at the beginning of every real expert, just to understand who the people are that are coming to this. We have some people who've been in the business for 7, 8, 10, 20 years. We have some people only been in it for 3 years. Heck, I think a lot of you are not even in the business yet. You're sitting in licensing classes. Look at everybody's putting in the chat. Hold on, I'm going to ask a poll question. You're going to have to answer it again. Here goes. I'm going to go ahead and launch a poll question
coming up your game.
Yeah. I love it. Everybody's on it. All right, do this. Answer the poll question instead of doing the text chat, and go ahead, drop it all in, and then we're going to share the results so everybody can see. I always share the results, Jerry. Everybody gets to play along. Okay. Awesome. Look at currently licensed, getting licensed. Go ahead, everybody, drop your answers in the chat. I'm sorry, not in the chat, in the poll question. And if you're on your phone, you're on your cell phone, you may have to swipe a screen to get to the poll question. All right. So, all right, I'm going to close down the poll. Looks like we got, oh yeah, we got a lot of people answering. Here we go. All right, ready? Here we go. 3, 2, 1, 0. End poll. And then I'm going to share the results, everybody. Take a look at that. All right, we got 59, almost 60% of you. You're not even licensed yet. Congratulations, you are ahead of the game. You are involved. If I had to bet, because not everybody makes it through the licensing education, Jerry, you know that, right? Not everybody can kind of withstand those rigors. It's a long haul. In a lot of states, there's a lot of long haul. We got people from all over the country. But if you're here and you're here voluntarily and you're doing your licensing education, odds are you're going to make it through and you're going to be successful because you've invested the time and effort. And that's really what it takes, Jerry, right? We're looking for self-starters in this industry.
Absolutely. That's the first step. Yes.
It's definitely the first step. So look at that. We got 59% of the people are not even licensed yet. Less than 3 years, we got 17%. 3 years to 7 years, 10%. How about that? So you've got people less than 3 years. You've really only ever done real estate during the pandemic. Interesting. Very interesting. How about that? More than 7 years, 14% of you. You 14%, you're going to learn something today. I did a pre-meeting with Jerry before this. I learned something. So good stuff coming on the financing side. I hope you're here for that. Jerry, let's go ahead and jump in. First off, what do you think has been the biggest change in the mortgage industry in the last, let's say, 12 months? What's happened? Get us to where we can talk about these items that are the big issues for people today.
Well, I think the biggest change, Toby, is the rise in interest rates.
Yeah, for sure.
And for those of you that have been in business, 3 years or so, when you got in the business, interest rates were about 3%. When I got into the business, rates were at 12 and then went to as high as 16%. But today, the rise in interest rates has affected the buyers, by the way, ability to qualify for homes. So, making them affordable.
Yeah, in fact, it's made it darn right unaffordable in some cases, right? So, because I think everybody knows interest rates are up. Interest rates, short-term interest rates, long-term interest rates. And here's the thing. Short-term interest rates don't necessarily affect the 30-year fixed rate mortgages, do they, Jerry?
That is correct. They do not.
But they can affect all the little things you can do to offset a 30-year a high 30-year interest rate, right? A high 30-year mortgage interest rate. A lot of the supplemental products and the supplemental ways, and we're going to talk about a couple of those and some really interesting things happening in the mortgage industry right now for products are going to be available to you and your clients. In fact, Jerry informed us of one that literally you can't get the loan until May 1st, but we're going to cover it in a second. So interest rates are high. And I think about it, Jerry, what happened to home prices? What happened to interest rates? How does that compound to make it so difficult for people to actually buy a home right now? What happened there over the last, 2-3 years to get us to this point where it's no secret the number of transactions is down, and a lot of it is a couple different ends. We talk about buyers being able to buy, and then the reluctance of sellers being able to sell. How is that home price and interest rate? How has that really affected people?
That goes, Toby, to your first question. The challenges we've seen in the last 12 months, and that was the lack of inventory. There wasn't enough homes for the number of buyers that are out there ready, willing, able to purchase a home. So, that's challenge number one. And we still have that issue today because, Toby, what you just asked is that I'll use myself, a baby boomer, and I have 5 kids and they're Gen X and millennial age now. They're in homes. They don't want to move because they bought in 2019, 2020, and so on. They got the low interest rates. Okay. So to move and they say, well, gee, I'm going to buy, I've got a rate now at 2.5 or 3%. If I buy a new house, it's going to be 6.5 or 7%. They go, gee, I don't know if I want to move. And then in the same token, a person that hasn't purchased, I was going, gee, is this really the time to buy? Because home prices have went up. If you take a look at the last 3 years, about 27% on a national level, 25, 30%, pretty big number. And people are going, gee, I don't know, I'm afraid to buy. And I can tell you from my experience, there is no better time than now to buy. When you say interest rates are high, yes, they've went up. Absolutely. They've doubled in the last 24 months. But a 6 to 7% interest rate for 30 years is a pretty gosh darn good deal
Yeah.
overall.
Yeah. It's hard
It
to
is.
imagine though. We were lulled to sleep with the low
Yeah, we
interest.
were spoiled, Toby.
Yeah. And just so everybody knows, we call it the golden handcuff. You know, when I have a interest rate, I have a 2.76% interest rate on my home, and I'm looking at, if I'm to sell and to re-up into something else that's maybe it's even a downsize, but I'm gonna have the same size mortgage, but my payment's gonna go up by $1,000 a month.
Exactly. Yes.
Why would I want to do that? I mean, that's crazy. And so that's a hard point for people to get off of, right? So what happens though, guys, is life happens, Jerry. And do people is there always a need for selling of real estate? I mean, always.
Oh,
right?
absolutely. Yes.
Yeah.
There's still people moving, and we got people from all over the country. It's from Florida to California. It's interesting. And I know Anthony made a comment, it's date the rate and marry the property. I like that comment. I like that one. But again, I'm sorry, I can't read the comment.
Oh yeah. No, so people are always going to move. So here we go.
Yes, so job change. You got the life-changing events that causes real estate sales is a job change, a relationship change, and a familial change. Those are the three tops. Three top reasons why somebody will buy. And those things are still going on. Absolutely.
And it always happens. Plus, there is no secret. There's a huge pent-up demand. By all estimations, we're still 3.3 to 5.3 million units short housing units in the U.S.
Correct.
So there is a demand. But how are they going to get there? So this is where we hope the mortgage industry comes to rescue us, right? And so, Jerry, what's happening in the mortgage industry kind of right now that is going to help kind of that pressure of homes that maybe buyers weren't able to buy because they were losing out on competing offers, and the home just kept going up in price, and it got to the top of where they were able to afford the home that the stay in their own community, and then all of a sudden interest rates rose up and pushed them right out of their own community. They can't even afford homes in their community, let alone so we're talking about affordability a little bit, but where's the mortgage industry? I mean, I remember when you got in the business back in the early, late 70s, early 80s, it had to have been where interest rates were 15, 16, 17%, and they came out with these incredible things called adjustable rate mortgages.
Correct.
Well,
ramps and assumptions
and buy downs and allowing people to get in at a lower rate, at a lower monthly cost, more variables involved than a fixed rate mortgage. But what's happening today? What's going to save us today?
And I'm going to type that in the chat box. And Toby, you'd asked me, LLP, pardon gang, I'm going to type in the chat box. It says LLP. Oh, I put a colon in. But anyhow, don't do it now. This is after the webinar here this morning.
Yeah.
But this goes technically into effect from Fannie Mae and Freddie Mac on May 1st. So, in 2 weeks. Lenders are already practicing this, and what the secondary market has done. Basically, let's think of it. They're the all-encompassing eyes, and they have oversight by Congress, our federal government. They went and then have created some solutions to help people still be able to purchase or own a home, even though interest rates have risen. There is incentives now that are going to be put in place, and it's called LLPAs. It's an acronym for loan limit price adjustments. Yeah, that's
loan level or loan limit.
Well, I'm right. Loan, I'm right, Toby. That's how I stop. It's loan level price adjustments go into place. So, starting now, this brand new gang. So this is great news. Somebody that's purchasing a home that has is at or below HUD's average median. Area median income, they will get a rate incentive, or let's say a discounted price on the loan, because they are low to moderate income borrowers. Borrowers, same person. This is called. Today, a person that also they take into consideration credit scoring. If somebody has a 680 credit score, last month, they were paying a higher interest rate than somebody had a 800 or a 750 credit score. And that difference was about 0.5%. So you take a $300,000 home, that's $1,500 a year. It's $125 a month in March now that it costs more for a person to own a home. To today, they would get that 6.75% interest, for an example. That's the same that a person get a 740 score. So it helps them have a lower cost of housing.
Yeah.
Okay. And also,
Yeah.
but besides the rate too, Toby, they also have incentives priced in for mortgage insurance, or the PMI that's being added on to the loan, because as you brought up, over 80% of the transactions that have closed, it's 84%, right in that number for the last couple of years, pretty consistent. People have been getting financing. And what's interesting to note is that the average down payment with those that got financing last year was 12%. So most of the people didn't put the 20% down. They have mortgage insurance on their loan. Well, now the mortgage insurance premium, this insurance that a borrower has to pay, is going to cost less. That's a
So let me give it back to you just so I can understand it. So
throw it at me, bud.
loan level price adjustments is really a tool that's going to be available, or it's available right now, but you can't actually take the money for the loan until after May 1st, right?
Correct.
Okay. So, but what it's going to do is it's essentially going to lower the interest rate for borrowers. And because they have to qualify though, right? And in order to qualify, there's a median income score or median income that they have to reach, or have to be.
Yes, in fact, somebody there, Faith, I think, just threw a question in. The area median income. I don't know why I'm having a hard time saying that.
Yeah.
Blah, 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 blah. The area median income does vary by state, and actually it's by county. So when we put in the chat box a link for y'all to go to, where you just put in the address of the property, it's going to tell you what the area's median income is. The max is for a family of 4. This example, where I live here in the Twin City in Minneapolis, or Minnetonka, technically is where I live, but here in the Twin Cities, the median income is $117,600, whereas in California it might, in Riverside, or was it Orange County, might be 210,000, and in Butte, Montana, it might be 76,000. It varies by county. Yep.
So the key here is the government steps in. All right, these quasi-governmental agencies, Fannie Mae, Freddie Mac, they step in and they say, we need to do something to help make homes more affordable, because not only have homes gone up in price, but the interest rates have gone up. And
Correct.
We're leaving an entire body of people, a demographic of people who maybe don't have perfect 800 credit scores. We're leaving them out of the entire equation. They can't even afford to buy. So how can we level set this? How can we make it so that it's affordable? And they've done. They got this program. The LLPA program comes out. Normally, you'd have to have an 800 credit score to get a 6.75% interest loan on a 30-year fixed. And now you can have as low as 680 on your credit score and receive a 6.75% interest rate.
Exactly, Toby.
Got it. Perfect. All right. So everybody, this is a big deal. You should understand that. And we should have the address. I think we were going to have Michelle.
It was way at the top of the chat box.
Is it all the way at the top?
Yeah.
We'll send it again, everybody. We'll get it in again. All right. So everybody will have be able to access it. All right. And the key here is, the big qualifier is there you have to have an income, right, that's at your or below your median income for your county, and you should be able to check that. There you go. Michelle OJ just sent this.
Yeah, thanks, Michelle.
Chat, everybody, take a look at the chat. Put that in there. It's and it's AMI lookup tool, fanniemae.com, and you should be able to find it there. All right. So there's other products out there. Right? I mean, tell me what's happening. Back when I got in the business back in 1991, the big deal was assumables and buy downs, because interest rates had ticked back up again a little bit in the 90s, and people were assuming these lower interest rates. Well, we've got a lot of lower interest rates loans out there, Jerry, and I'm hearing from a lot of people, how do I assume this loan from the because what happens is the loan is assumable from the new buyer, right? And the old seller says, yeah, I'll give you up my mortgage. I'll sign off on it. The lending company will sign off on it. You can just assume my loan. Is that happening yet, Jerry? Is there any problem with that or?
Well, I get what about 2/3 of the audience is your new licensees, or you're about to go through it.
Yeah.
You're going to learn about assumability of mortgages.
Yep.
And up until 1983, all loans, all loans, I say government loans,
Yep.
Were assumable to what's called a simple assumption, meaning a new buyer coming in didn't have to qualify. Since 1983, they've required, I think December 1 of 1983 was the date. All new buyers have to go through a qualifying process, and then they could take over the loan. It's called lender's discretion is the term. So you can learn about that when you get your license, okay? And so it means the new buyer's got to qualify. Now, you think about, as Toby, you and I shared, is that in the last several years, there's been, let's just say let me back up first. Today, only FHA, VA loans are what's called assumable.
So I go into a
Conventional
house
loans
with a buyer and the owner has an FHA loan on it for $200,000 and it's at a 2.8% interest rate. That loan is assumable, is it?
Correct.
Right. But
they've got to qualify. And then somebody, I think it was Deanna, would have just been a comment. Once the buyer, now the borrower, same person. Okay. So if I want, it's the same. So when the borrower goes through the qualifying process, that does release the original mortgagor from the liability.
Got it.
So that does. They're
the
able to
the seller's out, the buyer's in, but
that's
the buyer
on an
has to
FHA.
qualify. They have to qualify like a regular loan.
Yeah.
And what else? Because there's a problem, isn't there, in here with the way homes?
Well, yes, and I want to point out, on a VA, you don't have to go through the full qualifying, and there is not a release of liability unless the qualifying has been done to assume a VA loan. But what the challenge is with any assumable loan, especially if you talk about somebody maybe purchased a home in 2017 to 2019, and let's say they purchased a home for $250,000, and they bought, and we'll just keep it simple, $250,000 loan at 3%. And that house today, now in 2023, is easily $350,000. So the value has grown, or appreciation of $100,000. While the seller now, they want to move forward, they want to get their $100,000 and move on. That new buyer, if they want to assume the loan, they got to come in with $100,000 of a down
because they bought it for $250,000. Maybe they financed the whole thing. They have a $240,000 mortgage.
240, yeah, exactly, Toby. Yeah.
But the home sells for $350,000. How do so they sell for the loan is $240,000. You're going to assume the house sells for $350,000. It's a $110,000 difference. What do I do for that? Are there things?
Well, they could come in cash, or they could do a second mortgage. There are banks that are doing, which I've talked to you about. Yeah. There's second mortgages available where they could carry a first and a second.
Yeah.
Then so they could come in, for example, maybe it's 10% down. I think most banks now are requiring 10% down if you do a second behind the assumable first.
Got it. So they
can do what's called a wrap.
But the loan is assumable, but it becomes much more difficult because you have to
there's a lot of moving
product
parts
on it. You've got to do a jump through other hoops. All right. So assumable's possible, but tricky situation because there's generally a big gap between the cash somebody would have to
correct.
pay.
That's why it's not going to be very common, at least right now. I have not seen it.
Not seen anybody kind of successfully doing it.
And across the country. Yeah.
What about the next thing that we saw, which was how about those who've been in the business for 7 years longer? You remember, buy downs and paying points, and tell us about what's happening in the buy down market.
Well, that's a good question, Toby. Let me answer. Wendy's got just one question about the LLPAs. This new pricing model actually has gone in effect. It's for all loan types, just so you know. So it's all conventional. And I should point out, because some of you might be in commercial, you might be in land, you think about, I'm just going to do property management, whatever. But what Toby and I are talking about applies to residential properties, which are single family, townhouses, condos, co-ops, 1, 2, 3, and 4 units, okay, for across the country. So hopefully, Wendy, I answered your question there. It's for all loans that are out there. Now, Toby, you asked the question, and I already forgot what it was.
The buy downs. What are the?
Oh, the buy downs. Yeah,
because this is where the lending industry becomes creative and says, listen, we got to get these effective interest rates down to allow people to lock in, to qualify for more house, or to be comfortable selling their existing house and getting a new loan, golden handcuff. How are we going to do that? Tell us about buy downs.
great question. Because the interest rates have risen, there has now, it's coming, and this has been just this since 2023. They're now, and for those who have been around a while, this is going to be interesting for you, is they're paying points, or lenders are charging discount points up front to get the borrower a lower interest rate. And let me give you an example. So I'll use simple numbers. Today, the 30-year fixed rate's at 7%. Right now, about 1% of a payment up front of the loan amount, by the way, up front, can buy down the interest rate about 0.5%. Again, ballpark numbers.
So I go from 7% to 6.5% if I pay 1% of the overall mortgaged value.
Correct.
So I buy a $350,000 house, I put $50,000 down, I get $300,000 mortgage. 1% of that is $3,000. I pay $3,000 up front, and my interest rate goes from 7 to 6.5. Why is that advantageous?
Well, because you're going to save, if you just take that, you're going to save about $125. We'll just use, again, I'm using round numbers,
Sure.
$125 a month for as long as you have that loan. So if you pay $3,000 up front, you're going to live in a house for 36 months, you're break even, you've made, that's where now you've got your discount points back. And then for every month, every year you live in the home thereafter,
You're making
saved $125 a month.
Can I buy it down more than 0.5 point?
Absolutely. Right now, they're still keeping the limits to 3% is what's called sales concessions for people with 5% to put down. If you go 10% to put down, you can go to 6%. And then with 20% or more, you can go as high as 10. But I wouldn't do that. That's
It's really all about where's the payoff, how many years you get.
Yeah, that's what the return. Yeah.
And how big is the return? And who can pay those points? Does it have to come from my cash?
It could be from the buyer or the seller,
Seller.
and you could even get as a part of which I think we're going to get into, is some of the community and down payment assistance programs that are out there. They're paying points, or they're discounting the interest rate.
Right on. All right. So you go to the seller and you say, okay, seller, I'll pay your outlandishly high price, but I need you to pay 2 points towards my mortgage buy down in my closing costs, seller's contribution towards closing. And people are doing that like crazy right now, are they not?
Yes.
Yes. Okay. Now there's a couple other things too, because I think and I know we're getting close on time, but I really want to cover one more thing that I think everybody should understand. How the role of the real estate agent has changed. Jerry's been in this business 10 years longer than me, and we've seen the role of the real estate agent in conjunction with the mortgage lender, right, change. The whole mortgage process, between being very active in a part of it to being very hands-off. And Jerry has some new advice for where we're at today. But there's just a couple things. Buy downs, everybody. There's a couple different interesting things about buy downs. There's permanent buy downs and there's temporary buy downs, right, Jerry? And
correct.
And so you just be aware there's different buy downs. One is temporary, like you only get it for the first year and the second year, and it buys down to 30-year fixed rate. And then the other one is it's permanent, right? I mean, you buy it down once and it's permanent for the whole period. But you need to be aware of that difference.
Yes.
Okay. All right. So, Jerry, I want to go into the last question, because this is what I think is really interesting, especially those people who've been in the business long enough. You've seen this kind of thing. And what is the agent's responsibility? So everybody's sitting here going, yeah, I got to know about this. I got to know about this. What is the agent's responsibility for understanding financing, and what do they owe to their clients? What am I responsible for?
Well, now more than ever, the real estate agent needs to be an active partner in the process of buying and selling, by the way, either side of the table, an active partner with their client with the process if there is financing in the property, because it's important that the consumer shops, and that shops mean they're looking at more than one lender. I'm recommending 3.
As fast as this mortgage industry is trying to keep up, there are some that are getting to places faster, and the rate differences and the options are ginormously different.
Absolutely. And also, like all lenders may not be offering all loan programs that are out there. Some great new loan programs.
Got it.
Yes.
Got it. So shopping is important, because, hey, everybody, just so you know, there was a time when I was told you don't ask any questions about finance. You just, you just send them to their lender, and have the lender send me a letter. Those
Yep,
days are
correct.
gone. It's more there, and like Jerry said, you need to be an active participant. But go on, Jerry. What do we really owe our clients?
Oh, the
in this
fiduciary
process?
duties, Toby? Well, most importantly, when you're dealing with financing of the old car fiduciary duties is
Yep.
the confidentiality.
Yep.
That goes forever. You have the responsibility not to disclose the person's information.
Yeah, somebody's giving you their personal financial
Forever.
information. You
Correct.
cannot
So
discuss
you're
it.
getting involved as a partner in the financing. You're going to be learning some information about their income. And what I stress is important to know what the credit score is. And you're going to know that as a part of the process. You can learn that because it's going to help them shop for their home loan. And then it's loyalty. It's basically continually holding that buyer's hand through the process. And it's putting their interest above all others.
Why did you say credit card score? Why would I need to know somebody's credit score? Why is that so important now with my role of a participant?
Because the credit score is having with this new LLPAs that are now in place, it is having a significant effect to the customers or borrowers' interest rates or cost of financing.
And I would imagine knowing that, and then also knowing your own county's, median income level to know if somebody actually qualifies. Gosh, you have a lower
Yeah,
credit
absolutely.
score, you might qualify for this LLP program, right? And so,
Well, it's gonna affect whatever program they choose. Absolutely, Toby.
got it. And then we used to always say it before, I had to give 3 names for if I was going to refer somebody to a mortgage lender, I had to have 3 names. And what do you think of that today, referring somebody to at least 3?
I think it's important today. I used to say no, and I was just doing regular mortgages and say no, I'm your guy. But in today's world, if I was actively selling real estate, I always recommend that the real estate agent have at least 3 lenders that they've known, they've personally interviewed and know what their programs and products are. Yes.
And the key there is competition, right? So you could be
it's huge.
It's huge right now. The difference in the programs available and the terms available, people have to be up on it. There's other money available too that you need to be aware of. Tell me a little bit in our final minute here. Tell me about some down payment assistance availability, because you threw some numbers out earlier when we met that blew my mind. Like, how much money is really available for down payment assistance to people right now?
Yeah, real estate agents, and for those of you that are new, pay attention to this. You'll see, I'll put it's DPA in your local board. I typed in DPA, and that's the acronym for down payment assistance. There's now money available across the United States in every market, from $500 to as much as $100,000 available to home buyers to use as down payment to purchase a home. Okay. And you don't have to be a first-time home buyer to qualify. So if you might have owned another home, there are some sales price limitations and income limitations may be put in place. But my point is, there is billions, that's with a B, of money available to help people get a home. That's another solution that our government has come up with to help keep the housing market going
and it's everything
and making homes affordable.
Right. So there's federal, there's state, there's county, there's
absolute
local,
neighborhood programs, there's private investor program, there's employers are kicking in money. Yes.
Last thing, there's even money for energy improvements needed, right?
Correct. Energy improvements to fix up. Yes.
And so here's what happens. You need to understand what these down payment assistance programs are. If you're in an area where you're working with, understand what the demographics are, what the financial guidelines are. Not everybody qualifies for it, but there's a big chunk of people who qualifies, and there are some programs that everybody can qualify for. So you need to know what those are in today's day and age, because every single dollar makes that home more affordable. And that's really the key. And that's the key to financing. That's why we have these creative programs coming out, and you have to stay on the front edge of that. Me personally,
the real estate agent. Yes.
Yeah. As a real estate agent, I need to be connected to multiple lenders to understand what programs they have available as they are figuring out how they're going to make money and stay competitive in this marketplace. So there is a demand. And when people figure out how to get that lending done right, where it hits the spot where people are ready to move, they're going to be successful. And you want to be tied to those people. You want to make sure you understand those programs so you can be successful moving homes in what we call a tight market, which I think this is a tight market. All right, Jerry, we're at the end of our time.
Thank you, Toby.
And Jerry,
Thanks
thank you
again.
for being here. I appreciate you. I appreciate everything you do for our students. Jerry is teaches at Kaplan. I think Michelle put the name of a course that's coming out that will keep you up to date and go deeper into this information, because every single one of these topics could be talked about for hours. But thank you, everybody. Yes. Thank you for playing along, and we'll see you again soon.
Hope to see you soon. Take care.